organic growth focus and higher capital returns, all of these elements, which is what shareholders bought into, are gone and likely for years. That sounds like a sell, not a hold, but it's a hold. From Jefferies on UBS. With us now, Lafayette's Krishna Memani, Keith Lerner at Truist. Krishna, you've been great over on Twitter. I've been following your tweets on the banking situation, and there was a line you used, Krishna. The crisis isn't about deposits, it's about cheap deposits. Krishna, what did you mean by that?
Well, so if you look at the situation, if you are looking for replacement for your liquidity, you have BTFP and you have a discount window and you have Federal Home Loan Banks to kind of provide you that liquidity. The problem is that that liquidity comes at market rates as opposed to coming at 0% or 1% kind of a rate. And if you are having a problem in your books because of profitability, that is getting exaggerated. So what we are quickly transitioning from a liquidity crisis to now a profitability and capital crisis. That's at the end of the day, if left unchecked in 6 months' time, that's what we'll be talking about.
Well, the key caveat there, if left unchecked. Krishna, what can they do about it? Do rate cuts, are you suggesting rate cuts can address this?
Well, rate cuts could certainly address this to some extent. However, I don't see that forthcoming anytime soon. I think Jay Powell made that amply clear. I think vulnerable banks will have to come around to raising some capital relatively quickly and not wait till the day of the crisis like SVB did. So I think at the end of the day, if you want to save your bank, raising some capital at this point, even if it is at a huge cost in terms of dilution, that's something that you have to contemplate. That really at the end of the day is the solution.
Keith, two issues. One, some of these names face an existential crisis, we get that. But two, the broader sector, given recent developments, is going to face real profit headwinds. How investable do you think this sector is right now, from your perspective?
Well, I think it's going to be challenged. I think, as far as the one thing that's been discussed, probably ad nauseum, was that lending trends were becoming tighter even before this happened. Lending trends are only going to become tighter. There's going to be more regulatory scrutiny. And I will say, I think part of the challenge with this market is, like, yesterday you made a 2-year low in the U.S. bank index, and now you're also seeing that this morning overseas. So, you think about credit's the lifeline of the economy. We think recession risk is relatively high later this year. And even if the Fed cuts rates, we don't think that's going to change the trajectory. And all you have to do is look back at 2007 or 2000, knowing those were different situations than today, to see just because you cut rates, that is not a panacea for either the economy or for the overall market. And therefore, from an overall strategy standpoint, Jonathan, we still remain defensive.
So Keith, it's never just about the data. On this show we always say it's not just about the data, it's about how the market responds to that incoming information. Keith, last time you and I spoke, we talked about what you called the reverse Tepper trade, where basically bad news was bad news and good news was bad news. What is it now? I'm trying to understand how this market is going to respond to incoming information in the weeks ahead, given the introduction of these new risks over the previous 2 weeks.
Yeah, I think, on the reverse Tepper trade, I think the bad news is that more likely the economy is going to slow down, and along with those tighter credit conditions, profit trends are also going to weaken as well. What's curious to me as I look at the earnings growth or the estimates for the second half, analysts are looking for the S&P earnings to make all-time earnings high as far as on a quarterly basis in the second half, and that's just not consistent with an economic slowdown that we see. So the other thing I'll say, Jonathan, too, is if you look at right now all the things we're talking about, I think it's hard to argue that we don't have above average macro risk, right? Equity markets and credit markets are trading around average. So why are the markets trading around average when we have above average risk? Our view is they shouldn't be, and therefore, again, I think there's some downside risk both to credit and also equities more broadly.
Krishna, do you agree?
Well, I think there are substantial risks to both credit and equity for sure, given the way things are trending. But I would caution here that drawing too many conclusions from the bond market reaction for equity market, at least at this point, may seem a bit premature. I think what Powell did was basically told the bond market that the risks for now are really one-sided, which is rates go down because of tightening crisis, so or the credit conditions tightening. So I think bond market takes that clue and runs with it, and that's what they're supposed to do. Whether that will be validated by data, I think, is an open question today, and I think that's why, and that's what the equity market is thinking about. So it may come about that things slow down catastrophically, but it may also come about that things don't slow down as much as the bond market is fearing today.
Well, Krishna, you just said something interesting. You said whether that will be validated by data, and the first thing I thought of is what data? Are we going to pay any attention to incoming economic data points for the next month, the next 2 months, as we wait to see what the consequences were of the previous 2 weeks and what's about to come from the banking system?
I think we are probably going to discount near-term data, especially sort of pre-March data, as lagging data for sure. And that's what we are supposed to do. Having said that, I think if the growth trend or employment and hourly earnings and other things kind of continue to reinforce the point that the economy is not slowing down the way the 2-year notes would have you believe, I think that cannot be ignored for too long. We can ignore it for a couple months, but I think if it persists, that will not be ignored.
This is what Jim Bullard's got to say. First Fed Speak of the Week, post-Chair Powell hits the tape. Bullard says this: inflation remains too high. The St. Louis Fed president goes on to say it's appropriate for monetary policy, that it can keep lowering inflation. Macroprudential policy can contain financial stress. Keith, what are you looking for in the Fed speak in the coming weeks, and how relevant is it, given that this market is just living in its own world and trading on the future and discounting what it thinks is going to develop, which is ultimately an economic downturn off the back of financial stress, which delivers a disinflationary shock and tighter financial conditions?
You know, I think, Jonathan, I mean, before you even say what we're looking at, even if the economy doesn't slow down as quickly as maybe some folks are concerned about, you're already, in our view, trading at optimistic levels given the outlook. I mean, you're trading at above a 17 multiple for the S&P. If you look at high yield spreads, they're around 500. During a recession, the average is about double that. So to us, I think, we're not really pricing in that much bad news more broadly. And then you look at the S&P and look at the sectors. Technology is leadership right now, but it's trading at the highest premium in about 20 years. And then you look below that, the defensive areas aren't acting great, and we're seeing cyclicals come down again. So, as far as what we'd be looking at, I think the initial jobless claims will be important to validate that the economy is going to slow down. But, our point of view is all this, what we're talking about today, to us, not a lot of that is actually priced into the market today. It's to us still somewhat complacent relative to the news. If the market was marked down because sentiment is really negative, we would be much more positive here. We're just, we're not seeing it in the valuation data.
Krishna, something Jeff Rosenberg of BlackRock said earlier this week, I think you'll appreciate. The risk cuts both ways. We're all sort of focusing right now on the issues that have developed over the last 2 weeks, that it's going to develop tighter lending standards, financial conditions, disinflationary shock, all of that stuff, all the bad stuff. What we're not focusing on anymore is this idea that the Fed may have to stay here, stay where rates are, because inflation is going to be sticky through the rest of this year. Krishna, how much of the latter view do you think we need to pay attention to?
Yeah, so I think Rosenberg is a smart guy. So I think his point is a very valid one. That is, what we are reacting to is really a banking crisis, and the banking crisis may actually have a significant impact on credit conditions and growth outlook today. But saying today that what has happened in the banking sector may lead for the Fed to be cutting rates in June or May, I think it's a bit of a stretch at this point. And market is leaning one way hard, probably because of positioning, especially in the bond market. And I would guess that at some point that rectifies itself in not too distant the future.
We'll see. Hey, Krishna, this was great as always. Alongside Keith Lerner, Krishna Mamani there. 14 minutes into the session, your equity market shaping up as follows on the S&P 500, down about 0.7%. Coming up, TikTok in the hot seat.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it.
How would you describe it? That conversation up next.
Has ByteDance spied on American citizens?
I don't think that spying is the right way to describe it. I have seen no evidence that the Chinese government has access to that data. They have never asked us. We have not provided.
Well, you know what?
I've asked that.
I find that actually preposterous.
What a grilling on Capitol Hill. He never had a chance. The TikTok CEO facing off there with lawmakers in Washington. His testimony failing to satisfy officials eager to ban the video sharing service. Team coverage begins right now with AMH in Washington alongside Mandeep Singh here in New York. Anne-Marie, first to you. That's not how I would describe it. Those words, brutal.
It was brutal for him. The criticism just would not stop. He didn't get a moment to breathe. This was more than 4 hours of questioning and all these lawmakers critiquing his company. But Jonathan, there's really not much we learned from yesterday, except for the fact that bipartisanship, when it comes to this vitriol and concern about the TikTok app, that is alive and well in Washington. What really was key yesterday is what happened before CEO Shou Chew arrived at the Capitol, and that was the statement from China's Commerce Ministry saying that they would have to approve any sale for TikTok. And this just really undermined his entire testimony because lawmakers were trying to draw that link throughout this 4.5-hour hearing that TikTok does have some sort of link with the Chinese Communist Party.
Mandeep, if you're Meta, if you're Snap, you must have enjoyed that yesterday.
I think so. And look, when it comes to video content, even though Meta has, 2 billion daily active users, TikTok is where most of the video content, user-generated video content comes from. And that's why, the platform is so powerful is because, it has that engagement. So if you're a Meta or a Snapchat, you want to bring more creators on the platform. And this is the type of thing that can, shift the creators towards a new platform. Now, we did a survey where we found YouTube is still the preferred platform as an alternative to TikTok because YouTube has a revenue sharing model there. They share the revenue with creators. Meta and Snap don't do that. So we still think YouTube will be the biggest beneficiary if there was a ban on TikTok.
Those year-to-date moves for some of those names, wild, just monster moves. I want to come back to you, AMH, just quickly. Just got a headline that Secretary Yellen is convening top regulators. What do you make of that? How important is that issue?
Well, she's meeting with them this morning after we go into this third week, right, Jonathan, of this concerns and contagion in the banking sector. Obviously, there's concerns still about U.S. regional banks, First Republic being top and front and center. But then also there's concern about what's going on with Europe, with Deutsche Bank also deeply under the weather today. So she's meeting with these top regulators, not sure exactly what is on the agenda, but we look forward to see potentially any readout this afternoon from the Treasury Secretary.
It's not how I would describe it. I'm still trying to work out how he would describe it. Anne-Marie, Mandeep, forgive me, I'm going back to the TikTok story again. Breaking news just about 5 minutes ago. Let's get you some data. Here's Mike McKee.
All right, John, the S&P Global PMIs are out for the United States. They are all better. Manufacturing at 49.3 up from 47.3. Global services 53.8 from 50.6 and 53.3 for the composite. That's up from 50.1. Basically the same story we saw in Europe where all of the manufacturing indexes remain below the 50 level, but all of the service industries are above 50. Also, we have some headlines out from Jim Bullard basically saying Fed did the right thing. They had to separate the financial crisis from the inflation crisis. He says financial stress can be harrowing, but tends to reduce the level of interest rates, which could help the banks overall.
Mike, this week is never ending, isn't it? I imagine we'll get more Fed speak over the next week.
It's not.
It's got to end at some point. I feel like it started like March 8th, and it's just kept going. Mike McKee, thank you. We've got about 22 minutes into this session, and equities are down 0.7%. Katie has some sector price action. Hey, Katie.
Hey, John. Well, really quickly, let's look at those sectors. You can see utilities, consumer staples managing to stay in the green this morning. What's more interesting maybe is the losers. You have energy. That's been under pressure all week. Financials also under pressure, down almost 2%. If you look back over the past week, though, we know that yields have just absolutely plunged. An interesting response, though. You have tech higher, as you might expect, but utilities, real estate under pressure, not exactly the response you would expect.
Katie, thank you. Up next on this program, the Trading Diary, just to get you to the weekend and perhaps get you there quicker. 25 minutes into the session, we're down about 0.5% on the S&P. We're down 0.2 on the Nasdaq. That's the price action. Let's get to the trading diary. How do you stay out of trouble? You schedule a meeting with the Canadian leader. It's always safe that way. President Biden meeting with his Canadian counterpart at 11:30 Eastern Time. Fed speak picks up on Monday. Fed Governor Jefferson, plus we'll hear from Barkin, Collins, Williams, Waller, Cook throughout the week and a whole lot more. You get 2 days of congressional hearings on Silicon Valley Bank kicking off on Tuesday. Fourth quarter GDP, another round of jobless claims on Thursday. And we close out the week with the Fed Vice Chair for Supervision, Michael Barr's testimony on Capitol Hill. Look out for that. If you can, enjoy the weekend from New York City. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, March 24th. Here are the top market stories that we're following for you at this hour. The Deutsche problem. Shares plunged the most in 9 months. Default swaps and some of its debt surged. We're going to delve into Deutsche Bank's potential problems. And Deutsche really drags down banks here in the U.S. The U.S. financials sink. European equities down about 2%. Happy Friday, guys. You working this weekend? And flooding into safety. You got yields up, dollar and yen pop. Global cash funds raking almost $143 billion this week. And and stocks are lower, although off the lows. We're going to talk to Mark Lasry, Avenue Capital Group Chairman and CEO. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I really thought the open was going to be a lot worse than it was, and then we get the PMI data from the U.S. Business activity and services, it's still holding up relatively well. Does that continue?
That's the big question. We are going to talk to Chris Williamson a little bit later from Market. He's going to give us an idea of what's really happening under the hood with this data. But as you say, Alex, we do still have that kind of Friday feeling, don't we? Not the kind of Friday feeling you want. This is the wrong kind of Friday feeling. Are we going into a weekend where we're going to have to work because we're going to have to see another bank rescue? Deutsche, front and center. I have to say, the Markets Live team laughed when we posed our question today. Are we working this weekend? Apparently that's very European to even suggest, are we working this weekend?
I mean, I always work on the weekend in some respects, but I think that the point is that, like, over the last few weekends, it was SVB, First Republic, and then Credit Suisse. Like, are we have to be all on our emails waiting for the next shoe to drop, or is this just, let's just take off some risk into the weekend just in case, you know?
Yep. Well, so there's three theories I think I can kind of discern from today. One is we have a Deutsche Bank problem. But the German Chancellor Olaf Scholz saying apparently it's very profitable and therefore we don't have a problem. The second one is, as you say, we're going into a weekend and people want their weekend, so they're de-risking into the weekend so they can have their weekend. The third one is that actually this banking story is just a symptom of a wider repricing around a recession. And actually, it's the 2-year that you want to be watching because that's where the real price action is. Anyway, we can discuss this. We're going into a weekend. We hope it's a weekend. We'll wait and see. Is Sally Bakewell going to have a weekend? Is Eddie van der Volt going to have a weekend? Let us ask that question to both of them because they join us now to discuss. Sally, do you think we're going to get a weekend? What's the problem here?
I don't think I'm going to get a weekend. So just to recap, it's been a staggering few weeks in banking. We had the collapse of 3 lenders and one is teetering on the brink. And of course, in Europe, UBS took over CS. And the net impact is this intensely volatile, nervous banking sector. So First Republic is the one everyone is watching. It's a complicated situation. It needs a buyer or an equity injection. And what we're hearing is that banks can't quite get there on the economics of the deal because of this huge hole in its balance sheet created by mark-to-market losses. And that points to the need for government intervention. So what will that look like? We've reported the government is studying options like lifting some of those assets off its balance sheet to encourage a sale. The government doesn't want this bank to go into receivership because that would mean that the 30 billion injection by banks just last week didn't work, nor did the government's extraordinary measures announced in the wake of Silicon Valley Bank and Signature Bank's failures. So we could see some sort of deal, potentially Saturday, potentially Sunday, but it's all very much up in the air.
Okay, so Sally doesn't get a weekend because she heads up the American finance team. So that's like kind of one area of it. Eddie works at MLive. He blogs about markets. He talks a lot about macro stuff. Do you get a weekend?
I literally did laugh out loud, me and several people on the Markets Live team, because we were thinking exactly that. We were sitting there thinking, are we going to check, how many times over the weekend are we going to check our phones? How many times are we going to have to see whether, there is some new headline that is potentially going to implode the markets? Because, while we cover Markets Live, we're only open when markets are open. We are there when traders want to know, right? And if we see something happening over the weekend and people are wondering how to position for Monday, then, we want to get out there and start writing about it. So I honestly, I think this weekend's blown already, right? Whether or not we see a positive close to today, which I think is unlikely, to Guy's point about people de-risking before the weekend. I think, yes, Europe, later European days shifted very negative, and now the US comes in, it's like, well, hang on a second, what has changed?
Okay, so let me ask you that question. What has changed? I came in this morning scratching my head going, what's going on with Deutsche? What has anything significant happened here? But then you kind of think about it. Is Deutsche just a symptom of the fact that maybe actually we're repricing around a recession here? And if you're going to sell anything around a recession, the European banks after their recent run may be a good place to start.
Right. And Deutsche has seen a blowout in its CDS over the last couple of days, right?
Yep.
And I think if you're going to focus anywhere, then Deutsche in Europe is not a bad focus because it has been in the headlines, it has been trouble. I don't think there is anything new happening, but I think the European weekend approach that made people negative. They want to sell, they want to de-risk ahead of the weekend. The US comes in, they buy a little bit. So I think that we saw that little bit of a positive shift into the US morning. Does that sustain into the weekend? It's hard for me to say that because I do think people, you don't want to go into this weekend with a lot of money on the table.
Yeah, well, yeah, not after the last couple of weeks. Hey, Sally, I know you're focused on the First Republic problem, but, you know, if we isolate that as an idiosyncratic thing, and I use that in quotes, we're getting more and more conversations about actually this is a profitability problem, and we're looking at zombie banks in the small and medium regional banks as well. How much of that's going to be your weekend?
So I think there are a lot of these banks that all had this same kind of upside down balance sheet problem of having plowed a lot of money into assets that then saw their values eroded by interest rate hikes. And of course, this sort of contagion and fear has prompted a lot of depositors to withdraw their money. So there is a swathe of sort of regional banks that fall into that category. Now, it's been a week of serious convulsion in bank stocks, and to walk through the comments from Janet Yellen kind of suggests why. Yesterday, she told lawmakers that regulators would be prepared for further steps to protect the banking system if needed. That was aimed at avoiding a repeat of the sort of volatility on Wednesday when she said that Treasury officials had not considered nor examined the possibility of expanding federal insurance to back all US deposits. So I think there's a tremendous amount of uncertainty among investors who really want to know what the government will do to back this sort of tier of beleaguered lenders. And I think that will be the sort of indication as to how much this crisis can be contained.
Sally, can I just ask your thoughts on what is happening with money market funds as well? It does seem as if depositors want to have a weekend as well, and as a result of which they're taking above 250 and putting it into money market funds. We're seeing huge inflows. Do we think, are we sure that those are coming out of banks? Is that what is happening here, that a lot of people with more than that amount of money may be actually just transferring risk and putting it into the money market funds, which they hope are going to sustain, i.e. we're going to kind of keep the buck, and that's the safest place to put their money?
Yeah, it's probably part of it. I think some of that trend was already underway. A lot of the big US Wall Street banks, they haven't really passed on a lot of the interest rate hikes to depositors, although they're starting to do that now. And so depositors were already seeking, higher yielding accounts and products elsewhere. And that kind of was a big wake-up call for the US banks to start taking measures to pass those rate hikes on. And that's another interesting sort of consequence of all of this turmoil, is that a lot of those big US banks have now seen big inflows back again and are not losing customers perhaps at the same pace, and that kind of removes a little bit of that competitive need for them to thus pass on interest rate hikes. So it's all very, very interesting what is happening in sort of money market funds and with US banks' own products that they're offering and the rates that they're offering on those.
Yeah, 100%. And just how the money flows is crazy. Hey, Eddie, last word to you, the safety trade. I mentioned dollar-yen. A dollar and the yen are popping a bit. You got the rush to the bond market. Where's my gold rally, man?
I'm wearing my gold tie specifically for this, because this is the environment for gold, right? You're seeing rates going lower. You're seeing inflation staying hot. You're seeing a banking crisis and potentially the dollar weakening. This is absolutely about gold at the moment. And if it gets above that 2,000 level, I think we could get a bit of momentum here. One more thing, though, I just want to bring in. Valerie Teitel mentioned today about the data coming out later today, commercial deposit data for regional banks, which we're getting after the close today. I think that is the thing that could potentially ruin the weekend.
So yes.
On that note.
I think the answer is yes, Guy. We are working this weekend. Definitely check your phones today at 4 p.m. All right, Sally, Eddie, thanks a lot. We really appreciate it. Good luck this weekend. We'll talk to you guys later. All right, coming up, more on our question of the day. Are we working this weekend? So far, it looks like a yes. Cameron Dawson, New Edge Wealth Chief Investment Officer, joining us next. This is Bloomberg. All right, let's get back. Question of the day. Are we working this weekend? So far, the answer looks to be yes. Cameron Dawson, New Edge Wealth Chief Investment Officer, is joining us next. Cameron, you working?
I do think so. I think that there's still so much uncertainty about the future path of what's going on within the banking issues. The fact that we continue to see new relative lows and absolute lows for a lot of these big bank stocks certainly does suggest that we could continue to see issues bubble up. And I think as you were talking about earlier, watching what we see as far as deposit data and outflows will be really important. The fact that we're seeing money market inflows surge, that would suggest that these deposits are continuing despite the fact that you did see the deposit guarantee for SVB as well as Signature. And so what this could reveal is more balance sheet stress, not just on the duration and liquidity side of things, but what's going on with the credit portion of the loan books of these balance sheets. So we'll be watching that closely and likely still very engaged in what's happening through the weekend.
Cameron, can we have a chicken and an egg discussion? Because what I'm wondering here is whether or not the banks are a symptom or the cause of the concern that is increasingly growing around an imminent recession. I can argue it both ways. Credit conditions tighten, lending standards tighten, that forces the US into an economy, which is why we're seeing what we're seeing in the 2-year. The other argument is that we are just coming to the end of the cycle and we are going to need to reprice quite significantly, and the banks are just a symptom of that repricing around a recession. Which one do you think it is?
It'll be an unsatisfying both because they both feed on each other and really build on each other. The reality is that the economy is able to tolerate higher interest rates until you start to see credit growth start to contract. And we've seen this in all the past cycles, which is that even as you see the Fed tighten policy, liquidity starts to leave the system, as long as you are still seeing credit expansion, the economy still hums along. And it's once you actually see that credit contraction and start to roll over, that's when you slip into a recession. That's when you start seeing unemployment start to tick up higher. And so really, it is not just a matter of how tight policy gets, but what's the spark that causes banks to stop pulling back or start pulling back on credit? And this could very much be it.
Okay, so if that's it, why are markets still holding up? I mean, I appreciate the S&P is below 4,000, but like, how can you have a market rally or a sustained rally of any kind without the banks?
It is a really good question, and I think that there's still this hope in the early stages of this that you're going to see liquidity support the market, because markets are pretty well conditioned to think that Fed easing or balance sheet expansion results in higher asset prices. The problem is if we go back to the times that worked, 2016 or 2018, we didn't have a recession. We didn't have a downside adjustment in earnings. Earnings were about flat those years. But if we go back to times like the 2000s or in 2008, what we saw is that even as the Fed was easing policy, trying to pump liquidity into this market, it wasn't enough to offset earnings declines. So I think as we roll into April, we have to remember that earnings season starts, and it starts with the banks. And that's likely when we'll start to see more downside adjustments to earnings to reflect higher recession risk and more credit contraction.
Cameron, does buying tech because yields are lower makes sense right now? Because that's what's happening.
It certainly is what's happening. Tech is outperforming the market by over 15% year to date, and it's all based on valuation. We've actually seen tech EPS estimates fall throughout the year, but valuations are up nearly 20% year to date. And that's all based on this hope that lower interest rates will be beneficial to tech. And also this safety trade. Tech still from the 2020 period has this lean on it that it's somehow a very safe sector. Now, prior to 2020, tech was considered to be very cyclical. But the reality is that the equity market might be thinking that tech is safe. But if you look at the bond market, high yield spreads for tech are actually wider and now above their October levels for the tech sector, and they're wider than the broader industry or the broader sector basis. So what that suggests is that the bond market is saying that there could be more earnings risk that the equity market is currently ignoring.
Back to banks for a sec, Cameron. Are we creating a new world of zombie banks in that we had the liquidity issue, we're kind of managing the solvency issue, but now it's pure profitability when you look at deposit outflows or having to raise your deposit beta, and then you wind up having to pay a lot more for loans and you don't loan as much out because of the credit contraction. Where's the NIM, right? Where's the net interest margin? How do you buy banks?
I think that's a really good point, which is that we saw this step function lower post the great financial crisis in the ability for banks to generate the kind of return on equity that they did prior to the crisis. And what we could see now is that this lowers yet again, which just means that banks end up being these sort of quasi-public institutions that can't return as much as other parts of the market. The other thing to consider is that if we continue to see more and more concentration of the banks, of the largest banks, they have to be regulated even further, because then it's not just too big to fail, but then they become too big to save. And so I think that this does raise the question of profitability for the broader banking industry, which would suggest that valuations should trend lower in that price to book value.
So Cameron, we're going into the weekend. We are apparently working. While we're kind of waiting for whatever it is that's going to happen, we're probably going to be thinking about kind of how we want to invest. What are our portfolios looking like? What does the P&L do next? What do you think we should be doing? What kind of environment are we in here? What style of investing should we be delivering here?
Well, I think the first activity is to turn our eyes not just from looking at the income statements, but to looking at the balance sheets of the companies and portfolios. So when you're in an expansion, you don't care as much about the balance sheet because you have easy access to funding and liquidity. In times like this, you want companies that can self-fund their own growth. They don't need to tap capital markets just to keep the doors open and the lights on. And so looking at the balance sheets to look to see where companies are going to have to roll their debt and if it's going to come at higher prices, this is going to be highly critical in this environment. That's likely why small caps are underperforming so much. Small caps have a lot of floating rate debt. They tend to have a lot more debt, and so they're riskier, and thus they're underperforming these larger cap, higher quality companies. And so that quality bias, the thing that is central at that is strong balance sheet, strong cash generation, which we think continues to be the place to be in this kind of environment.
Cameron, I'm sure you're going to have a great weekend. Thank you very much indeed. Whatever happens. Cameron Dawson, New Edge Wealth Chief Investment Officer. Still ahead, Cathie Wood snapping up more shares of Block as the Hindenburg report fallout continues. Details to follow. This is Bloomberg.
Time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. Deutsche Bank has become the latest focus of the banking turmoil in Europe. Shares fell and the cost of insuring against the German lender's default rose. Deutsche Bank has staged a recovery in recent years after a series of problems. Today it said it would redeem a Tier 2 subordinated bond early, a move intended to give investors confidence. Microsoft's chances of winning approval for its $69 billion takeover of Activision Blizzard got a boost today. Regulators say in the UK that they have narrowed that scope of their probe to focus only on cloud gaming. They say the deal will not lessen competition in console gaming. Ford is raising its projection on how many electric F-Series pickup trucks it can build at a factory under construction in Tennessee. The new estimate, 500,000 a year. Now that's about 40% more than the company forecast in November. The Ford factory is due to open in 2025. And that's your Bloomberg Business Flash. Alex.
All right, Lisa, thanks a lot. All right, it's 22 minutes past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning, co-host of Bloomberg Technology, Caroline Hine, joins me now on set. All right, Caroline, we got the Hindenburg report yesterday. We have issues with Block. What's the day 2 story fallout here?
Well, the day 2 was a spillover effect of the Australian-related stock that was continuing to fall from Block. Today, it's down again in U.S. trading. And even though they're trying to fight back, saying that they might be looking with the SEC at legal action versus Hindenburg Research saying it's misleading, factually incorrect, people are still going to delve into just what Cash App was doing, how real the numbers are, what are the spillover effects here for. Ultimately, confidence in the stock, although someone had confidence around the stock. And we saw Cathie Wood of ARK doubling down, adding $20 million worth of Block, which has already had about 6% of her holdings are in that particular name. And so once again, this high conviction focus coming from ARK, from the ETFs that they manage to go back into those innovative companies.
Will create losses by selling stocks, and that gives us a tax loss asset, which we have. It's over $2 billion right now, against which we can take future gains, and then concentrate towards our highest conviction names.
Okay, so that's the reason why she does it. Tax loss harvesting. Everyone's thinking about it. We're in tax season.
Okay, maybe it's tax season, but but why is she doing what I'm genuinely questioning why she's doing what she's doing. She keeps stepping when companies are tumbling, she's stepping in. And I can understand the logic around that, but she keeps doing it. I'm wondering what she is seeing that others are not.
Yeah, buying the dip. But I think, Guy, what's interesting, we actually had Cathie Wood on earlier this week, and I asked her, when the chips were down, when the Fed was guiding for interest rates to go higher, why were you not diversifying more? And that's actually the opposite of what she does. When things go down, she concentrates. She focuses from more than 50 names back in the heyday of 2021 for ARK down to 27, 28 names. She thinks that that's actually the theory. You go in, you buy more of the particular companies that you think are going to create ultimate disruption. Then, when times get good, when the Fed starts pulling back, interest rates go down, then that's when you grow your portfolio once again. And she actually diversifies when the chips are down to a certain extent.
No, it's such a good point. And also because she has longer term theses. And we treat her more like a day trader, but she has longer term theses, and that's sort of difficult. So why does she like Block?
Thinks it's going to disrupt overall finance. FinTech more broadly. Block has exposure to crypto, and we know that they're a strong believer in crypto and the future of decentralized finance. But this is also about democratization. This is access to banking. And actually, if you think about what's happening over at Block at the moment, fraud has always happened within the banking system. People are worried about some of these newer financial endeavors because the pace at which everyone's going into them. The sudden worries about certain compliance when you're onboarding like mad, when people are wanting to use these different types of banks that aren't regulated in that normal way. They don't have their own banking license. They use a different bank as the way in which they issue your debit cards. And so I think this is at the moment a play on the future of finance, the fact that they believe Block hasn't done anything wrong here, I'm sure. They do believe perhaps that the Hindenburg Research is just elevating things that everyone already knew and had been disclosed by the company. And now it's time to buy the dip because ultimately Block is going to disrupt the way in which you and I send money to each other through Cash App, through the likes of PayPal's Venmo, and it's going to be a challenger to the big banks.
Yep. We'll see how this one plays out. It's going to be an interesting story.
It is.
Certainly we've seen Hindenburg having some big hits over the last few years. Caroline, thank you very much indeed. Bloomberg Tech coming up. This is Bloomberg.
hour to the U.S. trading session. It is not what I expected when we walked in this morning. If you look at the futures, we really bottomed at around 8 o'clock and then kind of clawed their way higher here. We're now S&P just down 0.2%. Tech just down 0.2%. Yeah, we got that pretty strong PMI in the services and manufacturing sector as well. So the fundamentals still showing strength. I just want to point out Deutsche Bank, though, because that's still down by about 10%. That's really dragging European stocks lower. It's also leading to some underperformance over in Europe, and we really thought that was going to be a strong drag on U.S. equities. It's just a minor drag at this point, and you can see it in the bond market as well. I want to take a look at the 2-year bond market in different countries here. You see a bid in for sure, but the U.S. Is just down 13 basis points. We were getting a lot more strength of buying earlier in the session. German 2-year yield down 16 basis points. You got France down 16 basis points. They still have strikes going on, so watch that as well. Let's get to some movers here because we want to look. First Republic, we'll get to that in a sec. You got Activision Blizzard. This is very much an idiosyncratic situation. The UK Competition and Markets Authority updated its provisional findings on Microsoft's acquisition of the company, and this was a positive, so getting a little bit of a boost there. The KBW Bank Index, though, still off 1%. In fact, Morgan Stanley is the second worst performing stock on the S&P, down almost 4%. Citizens Financial may be looking to bid for some SVB assets. That was in a recent report, so that getting a pop, which is interesting. Considering how no one would kind of touch that with a 10-foot pole. And then First Republic, what happens over the weekend? Sally Bakewell saying her weekend will be ruined because of First Republic. So what's going to happen? Herman Chan of Bloomberg Intelligence joins us now. Herman, are you having a weekend? What's going to happen with First Republic?
I've been looking these weekends for a while now. So Sunday around 7 o'clock, I'll be on the terminal and seeing what news flow happens.
What are you expecting?
Well, SVB should have some sort of resolution. The FDIC, it's been reported that the FDIC will have some sort of announcement in terms of the auction process for both the wealth management assets that you just mentioned with Citizens and also the commercial bank with some of the names popping up like First Citizens and also Customers Bancorp that just popped up yesterday. So some fireworks perhaps, so we'll see.
Herman, what is the data later going to tell us about the state of play within the regional banks in particular? What are we going to learn in terms of how stressed they actually are going into this weekend?
Sure. If you look at some of the data that came out from the Federal Reserve actually just yesterday in terms of the discount window usage, in terms of the liquidity program that the Fed unveiled a couple weeks back, it shows some stable balances, which to us seems to show that the contagion risk that a lot of folks were worried about hasn't really popped up after the big run-up from the SVB fallout. So all in all, it does seem like things have stabilized a bit, which is really reassuring. I would say that earnings is coming out in 2 or 3 weeks, so we'll have more clarity from those reports.
We're going to get deposit outflows from Wednesday to Wednesday. So we'll get from March 8th to March 15th Correct. At 4.
Right.
What are you going to be paying attention to? Because it's not totally up to date, but it will encompass SVB.
Correct. So it'll be the first date in terms of the balance sheet changes for the overall banking industry after the fallout from SVB. So it'll be our first look from a bank balance sheet perspective in terms of how deposits flowed out of the banking space.
Herman, great stuff. Thank you very much indeed. We'll look forward to that data a little bit later on. Herman Chan of Bloomberg Intelligence. Let's get back to our question of the day. It's Friday. Are we about to have a weekend? That's our question. Last weekend was a little rocky. This weekend, we're watching what is happening with First Republic. We're wondering what's going to be happening with Deutsche Bank. Mark Lasry, Avenue Capital Group Chairman, CEO and co-founder, of course, the co-owner of the Milwaukee Bucks as well. We're going to talk about that in just a moment. Joins us now. Mark, thank you very much indeed for your time this Friday. What do you think is going to happen this weekend? The market feels a little jittery going into the next couple of days. People are de-risking maybe going into this weekend. How do you view what is happening right now? Do you think you're going to be getting a weekend this weekend?
One, thank you, but I think people are just nervous. And, what ends up happening is everybody just keeps looking at what's happening. You sort of see the news on Deutsche, so people will be a little bit more nervous going into the weekend. Really what's happening is people are trying to figure out should they keep their money in sort of banks like First Republic, or should they keep moving their money into banks like Citi, JP Morgan, Bank of America, and that's sort of what's happening. And, that's going to take a process. And the question is, is everybody going to settle down, or are people just over time going to be moving their money into the big banks?
Mark, what do you think that they should be doing?
What do I think you should be doing?
Yeah, I mean, like, should we be moving money out of deposits and putting in money markets and getting 5%? Should we be looking at potentially universal deposit guarantee? Like, what do you think we should be doing?
Well, if you look at it, what is the benefit of keeping your money in sort of a smaller bank? Even if that bank is doing extremely well, it's not one of the banks that, in essence, the Fed worries about systemic risk. So even if there's a 1% probability, why wouldn't you move your money into sort of JP Morgan or B of A, into the banks where you know that if there's a problem, the Fed has to step in? So ultimately, all of this is a question of trust and sort of confidence. And, the Fed is trying to give everybody back that confidence. Yeah. But if you're a business and you've got 100 million or 200 million in a small bank, should you move it? And I think ultimately people will end up doing that unless the Fed gives people guarantees that they've got nothing to worry about.
So, Mark, what you're saying is that unless the Fed does do that, unless the authorities do step in and provide guarantees, the regional banking system is unstable at this point.
It's not that it's unstable. It's just that the question is the risk of keeping your capital there, even if it's a 1% probability, should you move it? And that's really the question.
But Mark, if the answer to that is yes, then the next logical conclusion is that these banks have a problem, because we are going to continue to see deposit flights, and they are going to have an issue with their depositors just on an ongoing basis continuing to leave their business. So I'm wondering where that ultimately takes us.
I think you're going to start seeing the numbers, and in essence, over the course of next month, if you're going to start seeing that deposits are moving out, then the Fed will have to step in. If you see that deposits have stabilized, then the Fed has done their job and given the confidence back. Mm-hmm. All I'm saying is, if I'm the CEO of a company and there's a 1% probability, what do you think you should do? Ultimately, I think people will end up moving their capital out.
Mark, you're many things, but you're also a distressed debt guy. When you take a look at the system, where are the opportunities and where is the trap?
Oh, the opportunities for what we do right now is immense. And I think it's for anybody who does private credit. And the simple reason for that is it's going to be more difficult and it's harder for banks now going forward to lend capital. Or even if they lend money, they're going to require different covenants. It's just going to be harder. So for folks like me, you're going to be able to step in. You're going to be able to lend money. It's going to be sort of a golden age for us, because we're going to be able to come in, and the banking system, in my opinion, right now going forward, there's just going to be more requirements. There'll either be more equity requirements, banks are going to be more careful, the Fed is going to supervise more. So all that means is that it's going to be harder to lend, and for folks like me, it's going to be easier to come in and sort of dictate terms.
Net, Mark, what you're talking about is a tightening of lending standards. And I'm wondering what kind of a default rate ultimately we're going to see off that, see coming off that. The banks are going to be more cautious. They're going to tighten up on who they lend to. You're going to be lending, but probably at higher rates going forward. That's a tightening of lending standards. Does that imply a significant step up in the default rate?
It implies that the default rate should move up. How much, I don't know. The economy is still doing well, but ultimately, if you're not going to be able to borrow, it's going to have an effect on businesses, and therefore you're going to have more issues.
Mark, we were talking to Bruce Richards earlier this week, and he echoed something very similar. He definitely said the golden age of credit. He was talking about 10% default rates. He was looking at some bank assets, because banks are going to need funding. Going to the government is going to cost a lot, so they're going to have to, at some point, offload assets. He really didn't like things like commercial real estate. Can you dig in a little bit as to the landscape?
Well, the reason he doesn't like commercial real estate, and I don't want to speak for Bruce, but I would say to you right now on sort of loans, just look at New York City. You had a number of buildings where people ended up borrowing, having a fixed rate mortgage 2 or 3 years ago at 2% or 3% or 4%, whatever the number is. Today, if that loan came due, you're not going to be able to lend at that same level, so it's going to come due and you're going to pay somewhere around 7-8%. So the cost of capital for everybody is going up. That's going to create issues. Whether it ends up being a 10% default rate, I don't know, but it's definitely going to be a much higher default rate. Or banks are going to have to end up just rolling over those loans. But there's going to be issues and stress within the system over the course of the next couple of years because of that.
Mark, just to go back to the conversation we were having with Bruce, he was actively talking to banks. He was actively having conversations with people right now. He says there's probably a bigger opportunity further down the road, but those conversations are starting. Who are you talking to right now? Are you talking to the banks about buying assets? Which conversations are you having and with whom?
Well, we're definitely having conversations, but I agree with Bruce. It's a bit early because banks today don't want to take the reserves or don't want to take the losses. So I think what you're going to find is as the Fed comes in and forces banks to take reserves, that's when the opportunities come. It's not today. It's going to be over the course of the next 3 months, 6 months, a year, when banks have to take reserves. So really what we're doing, and I assume what Bruce is doing, and folks like me are doing, is having the conversations, getting yourself in position, because there's going to be a huge amount of paper over the course of next year that we can all buy.
All right, Mark, let's talk about your other venture, sports, talking about the Bucks. If the Bucks win again this year, and it looks like they very much could, does the value increase, and by how much, and like how does that help you sell it?
I think whenever you win, more people would like to own a team. So I think right now what I'm really focused on is for us to end up finishing out the season. I think right now we're number one. We're about 2.5 games up. So if we can continue and just become the number one seed, that's going to help us. It'll help the value of the team, but more important, it'll help the team win another championship.
Mark, do you think we are, though, getting to the near-term peak in terms of sports franchise valuations? To conflate these two conversations, it sounds like we're going into a period of stress. We have seen sports franchises valuations go up significantly over the last few years. Are you selling at the top here, do you think?
No, I think going forward, you're still going to find valuations moving up. It's just not correlated. I think ultimately at the end of the day, it's the only thing you can watch live. So I think it's something that's pretty unique, and people still love sports. So still love it. I think it's still, one of the things I want to continue investing in, and it's probably one of the reasons we're going to end up doing a sports fund so that we can continue investing in this asset class.
What do you like, Mark, in the sports world? What are you looking at?
There's a lot of things I like. I ended up investing in pickleball. I'm trying to do padel. There's just, when you look around, I think you're just going to see a massive amount of growth in the industry.
Pickleball, man. I got to figure that one out. Before we let you go, let's talk about Bitcoin for a second. I know you've invested in Bitcoin personally. You're invested in crypto firms like Block Tower Capital. Where are you right now? Where are your investments sit in the crypto world?
I'm pretty comfortable with the positions I have. I'm not adding right now. I made my investments. I'll see what happens over the course of the next year. I think right now there's far, far more opportunities in what I do day to day, which is on the lending space and on the private credit. So that's where my focus is right now.
And pickleball. Hey, Mark, it's been a really long time. It's really great to chat with you. Thanks a lot. Definitely come back. Mark Lazary, Avenue Capital Group Chairman, CEO, and co-founder, and co-owner of the Milwaukee Bucks. All right, coming up, cash is king. We're going to take a look at where the money flowed through the week in today's ETF Friday. I'm sure you can guess. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Lisa Mateo. U.S. prosecutors have charged Terraform Labs co-founder Do Kwon with orchestrating a massive cryptocurrency fraud. It's said to have wiped out at least $40 billion in market value. Kwon was already a fugitive from charges in his native South Korea. He was arrested Thursday in Montenegro. In Japan, inflation slowed for the first time in more than a year. Consumer prices, excluding fresh food, rose 3.1% in February from a year ago. That's down more than a full percentage point. But without the impact of government subsidies for energy and travel, inflation would have been as high as 4.4%. In North Korea, Kim Jong-un oversaw tests of weapons designed to deliver nuclear attacks against the U.S. and its allies. One of them was described as an underwater drone that can create a, quote, radioactive tsunami. The official North Korean news agency, it says the drone cruised for nearly 60 hours before detonating. The test also included cruise missiles carrying mock nuclear warheads. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. Alex.
All right, Lisa, thanks a lot. So it is ETF Friday. So I want to take a look at where money flowed this past week that was really marked by bank turmoil. Joining us now, Bloomberg's Katie Greifeld. So Katie, it won't be a surprise, but I'm going to guess money market funds just by the amount that, say, Bank of America saw flow into global money market funds.
Exactly. I mean, these aren't ETFs per se, but I feel like we have to talk about it just because if you look at the fund universe, this is all the rage right now. Money market funds have taken in about $230 billion of new cash over the past 2 weeks. Assets are at an all-time high. This money is going to government funds, which is the interesting twist here. So that's primarily treasury bills. And then if you look at prime funds, for example, which hold commercial paper, theoretically the riskier stuff, they've actually seen a fall of about $10.8 billion. So a lot of demand still for treasury bills. You think back to the start of this banking crisis, if we want to call it that. We know that banks have been struggling to hold on to deposits because you can get a higher return in some of these money market funds.
But so are people putting it into money market funds because they're getting a better return because the banks aren't giving it those returns, or are they putting it into the money market funds because these are non-insured funds and therefore people are frightened of leaving them in the banks?
It's a great question. I mean, I would imagine it's a mix of both. Also, I would imagine, I mean, to that latter point, this is sort of a safety play if you wrap this into a view on the markets. And if you're an optimistic person, you see, what, $200 billion going into money market funds saying, this is dry powder. This will come back into the stock market at some point. That's the optimistic case. But then you remember, if you're looking at some of these extremely short-dated treasury bills, as safe as you can get real yield here. It's playing offense in defense, so it might take a while for these assets to come out. They'll probably be a bit sticky here.
Sports reference. Where's the money coming out of? Where have we seen outflows this week?
So if you look at the outflow picture, honestly, it's surprising. You've seen a lot of really money go across really all assets. You're seeing money go into big tech. You're also seeing it at the same time go into long duration treasuries in addition to sort of the very short end of the money market curve. So that's a really interesting dynamic. If you think about the pandemic playbook, long dated bonds, tech stocks, it seems like that is back in focus right now. People just want safety, and big tech has turned into safety.
You said something really interesting a moment ago. Do people, I wonder if the attitude is changing. People assume that the money in money market funds belongs to the equity market. Why?
That's the thing. That has always been sort of the profile of money market funds, if you want to call them that basically they're this way station before you go back into real asset classes, before you go back into equities or wherever it was before. But really over the past year and a half, really since the Fed has started hiking rates, cash is now its own asset class. It stands on its own. When you look at a 6-month treasury bill, for example, and get, 4.5%, 5% or now, you don't really need to go anywhere else. So, I mean, that's the conversations I've been having with investors for months now, that if I can wait out whatever the heck that we're going through in the economy right now and all this indecision around what the Fed is going to do and clip those types of coupons, why would I be anywhere else?
Totally was thinking the same thing. just earlier this morning. So new ETFs this week. Anything came out?
New ETFs this week. I love this one. So there was one from Roundhill, the Big Bank ETF, ticker Big B. So it holds the 6 largest U.S. bank stocks. It's equally weighted. So it's in an incredibly concentrated portfolio, just 6 holdings. I asked them why. And they said, basically, if you look at some of the sector funds that are out today, XLF, for example, only 30% is actually in financials. So they wanted to provide this extremely specialized exposure, and they're launching it really in the eye of the storm.
It's going to be an interesting few weeks for these guys. The money market stuff, I think, is fascinating. Katie, thank you very much indeed. Katie Greifeld. Tune in, of course, to ETF IQ every Monday. 1 p.m. is when you want to be tuning in New York time for ETF IQ. Definitely worth a watch at the moment. This is Bloomberg. So we're coming towards the end of the European session, a little longer. Remember, the clock's changed this weekend, so we've got an extra hour here today. But next week, we'll be back to normal. What kind of a weekend are we going to see, apart from the time change? I think it's a big question that everybody's trying to figure out right now. It has been a bumpy Friday. Are people simply just hoping they have a weekend and therefore are de-risking? Deutsche Bank in the eye of that storm, certainly down by 11% today, but off its lows, which is significant. The German Chancellor saying this is a company that is profitability. This is a bank that is stable. The German 2-year, we're, as you can see, off our earlier lows in terms of yield, so a little fade on the bid, but nevertheless worth watching. And yesterday we posed the question in this hour, are we seeing King Euro? We got a sharp rebuke on that one, didn't we? Look at the dollar coming roaring back today as we see this pain here in Europe. Coming up in the next hour, I've got 2 Chris's actually. Chris Watling of Longview Economics is going to be joining us. Chris Williamson to talk about the PMIs is also going to be joining us. That's coming up next. This is Bloomberg. Friday, the 24th of March. Yes, it is Friday, but we're going into what could be a bumpy weekend. European equity markets selling off pretty hard today. The banks are down. Deutsche's at the kind of the center of the storm. But interestingly enough, oil stocks are also down fairly sharply as well. We're going to talk about both of those two stories in the second hour of Bloomberg Markets, which starts right now.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So it was ugly early on. It's improved since then. The banks are still down 3.83 as we go through into this weekend. Deutsche Bank at the center of the storm. The question is why? And we're going to try and solve that over the next hour. Is this